Okay, good morning, everyone. I hope you guys are feeling well after yesterday's, if you guys went to the award ceremony last night. And so I hope everyone takes notes today because there's going to be a 25 question exam at the end. Totally just kidding. So, but it's supposed to be interactive as well. So hopefully I won't bore you to death. So if you have any questions along the way, or, have any curiosity or whatever on any of the slides, just let's have it. So we'll talk about it. So, all righty. And just go. Okay, so like today's agenda, what we're going to start with is best practices when working with lenders, how mortgages really work, the different types of loans, and then relevant contract addendums and provisions, which we'll wrap up with Zareen. And Zareen, make sure you cut me off if I do a relapse of before.
Okay, perfect. Yeah, we'll hit the high points.
Exactly. So I'll kind of go to a high level. So I won't go into too much detail. All right. So best practices when working with lenders. So does anybody know the difference between pre-qualified and pre-approved? When you're out there, you've got a buyer that's looking for a house.
So would pre-approved be it went through underwriting already?
Not exactly. Actually, that'd be conditionally approved. And so, but that's a good guess. Absolutely. So pre-qualified is basically a buyer doing an application and just stating their income and assets. So there's no documentation or anything like that. So to be honest, it's pretty worthless regarding if it's to a listing agent, because as we've known in the past, like prior to 2008 and all that good stuff, everything was stated. So so that was one of the big reasons why everything collapsed, is that people were, school bus drivers claiming that they made $500,000 a year. So on a pre-qualified letter, a buyer can pretty much put anything they want, it's just stating their income, if that makes sense. And then, so if someone says, hey, I got a pre-qualified letter, I would let Ashton or myself take a look at it, or make sure that, or ask the buyer, hey, listen, did you send docs in your pay stubs, bank statements, W-2s, or tax returns? Because if they didn't, then it's not really valid. And so you don't want to be like, going through the process, put an offer in, and then come to find out that the buyer overstated their income by like $5,000 a month, and that's happened all the time. So, and then and then they can't qualify for the loan. So a pre-approval, pre-approved or pre-approval letter is just that in regards to the opposite. So it's where the lender has collected. Normally, if it's a W-2 employee, it's like the last 2 pay stubs and then their last year's W-2. And so, you've got the income, and you can calculate it. And then also, normally we want to know what the assets are. So a lot of times, lenders will request two months bank statements as well. But if they're getting a gift and things like that, assets are a little bit less, but more or less, we want to make sure that the income is working with the ratios. So a pre-approval letter is like the Willy Wonka golden ticket when you're, making an offer on a home. So does that make sense? Is that okay?
So, cool. So you want to see a pre-approval letter, not a pre-qualified letter. Correct.
Yeah. And so probably should edit number 2 because then just take out the pre-qualification letter. You really just, like Zareen said, you really want a pre-approval letter because again, it's validating the income and assets. And so, and then of course, number 3, you want to have a good working relationship and communication with your buyer's lender. You want to make sure that head off any fires prior, to moving forward. From a high level, lenders can't talk to you necessarily about the finances, if you will, but they can give you a general idea of like, hey, listen, we're going to have this thing's going to be pretty hairy or whatnot. And then also, as it goes along, you want to make sure that you have great communication So there's no surprises at the end.
So one thing, guys, that's an important one, because I think we all are like, oh, well, we want to talk to the buyer's lender and make sure that they're qualified. And that's obviously true. But we were talking yesterday in legal too about like the addendum to terminate due to appraisal. And that's another one where you need to be really in close contact with your buyer's lender, because you don't want to put numbers into those blanks without first talking to your buyer's lender and making sure that your buyer can actually do whatever you're putting in there. So just if you have a really good and close relationship with your buyer's lender, they're kind of actively involved all along the way. You shouldn't be operating in an island without talking to them with respect to anything in financing, even, like 12A1B, when you put a closing cost number, you need to talk to the buyer's lender to make sure that that number is actually available in closing costs. So that's what we mean by having a good working relationship and communication. They should be integrally, when you're negotiating mid-contract, there are going to be times when you need to reach out to them.
Yeah, great. Thank you, Zareen. Yes,
Yeah, no problem.
Absolutely. And then, request communication from the buyer's lender when you're the seller if necessary. So on all of my deals in Ashton's, we will call the listing agent. Hey, listen, this file has been conditionally approved. It's super solid. We're putting 20% down. This is a golden ticket. So again, just kind of like piggybacking what Zareen said, it's always good to have that communication. And then also putting in a strong offer, of course, as well. So, not to pitch connected, but our goal is while you have buyers looking for properties is to get them pretty much fully approved prior to finding a property. And then that way we just order the appraisal, lock the rate, and rock it out. So, and then that way we can give a very, very strong offer to the seller. So is there any communication? Is there any questions on that? Okay. Next, the 4 pieces of a mortgage puzzle. So we have to have all of this in order for the loan to work. So of course you have to have income, debt. We don't have to have debt, of course, but it does help to have some trade lines and debt regarding to that build your credit. Of course, then you have to have credit and you have to have assets in order to have a down payment or for closing costs. So, and please stop me along the way if you have any questions. So.
That's why we tell people don't go buy a boat while you're in your financing, right? Because then you're financing it and it's changing the amount of debt you had. It's messing up all those ratios.
Absolutely, 100%. So mortgage 101, we do have a presentation on that too. So first time home buyers, kind of like tell buyers, during the process, don't go buy a Ferrari, don't buy something crazy because you're going to mess up the ratios. So here we come to this. So debt to income ratio. Has anybody, well, I'll just kind of tell you. So what does it mean? So front end ratio, and you have a back end ratio. The front end ratio, put simply, is your monthly PITIA, which is principal, interest, taxes, and insurance, and homeowners insurance possibly, against the monthly income. And so that's that ratio. And so the back end ratio is the PITIA and including all your other monthly debt. So if you've got credit cards, auto loan, boat loan, so things like that, and then that goes against your monthly debt. So the ratios for different products, conforming loans, government loans, FHA, USDA, VA loans, they're all a little different. So conforming loans, really, you cannot go over a 49.9. So these are a lot of things that we're looking at as a lender. We are seesawing the effect of regarding down payment, how much the buyer's income is, how much debt they have. Hey, listen, if the ratios are too high, maybe we should pay off some debt. Maybe we need to refinance something, maybe a car, things of that nature. So this all plays in a part of getting the buyer approved. So conforming loans on the back end, they don't really have a max regarding the front end, if you will, but the back end can go to 50. It cannot go to 50. So 49.9, and that's it. That's the max. FHA, they're a little bit more lenient. it's government backed. So it's, the front end actually can go to 46.9 and the back end cannot go to 57. So,
John, I think this is probably like a little bit overcomplicated for what an agent needs to know.
okay.
Unless you think as how.
No, I just don't. They're just, yeah, maybe I
Just
should have
giving an example of what you guys are looking at.
There's just different ratios for different products. Let's just put it that way.
Okay,
So,
that helps.
yeah. And just because the ratio does fit the product doesn't always necessarily mean that it's approved, it's approved, of course. So.
Gotcha. So you're looking at those 4 pieces of the puzzle and seeing what their debt to income ratio is, and there's certain like limits that they have to qualify for to even be eligible.
Correct. Right.
Gotcha.
And
Okay.
just kind of explaining that's, regarding the down payment, income, and the debt. So those are the things that we look at as lenders kind of in the background going, okay, how do we make these ratios work to get the buyer approved? So,
Perfect.
and regarding rates and points, so let's just start, everyone knows you can buy down rates. And also, and then there's no cost per rate, right? So par means no cost. So the rate and the fee, basically you're not buying down the rate or doing anything of that nature. So for an example at the bottom, I locked in at 4% with no points. So someone says that it was at par rate. So that's what that basically means, just at par. There's no cost. Now, when you're getting a lender credit, it's a little bit different. This means that your rate is going to go up a little bit because maybe you're low on cash for closing costs. So the lender will give a credit to you, basically give you cash, but to seesaw that, they're going to raise the rate a little bit in order to compensate for giving you that lender credit. So kind of call it premium pricing. But that's what getting a lender credit is. So again, it's giving credit, but they're raising the rate a little bit to compensate for it. And then paying points, of course, is that we pretty much kind of all know is that where you're paying discount points. So that means is that you're, just for an example, I locked in at 3.75 and I paid 1 point for it because I wanted to secure, a lower rate for 30 years. So again, paying points, paying discount. So points are discount points. If anybody says, hey, I'm paying points, it's just discount points. And so, so those are really the 3 categories, if you will, in regarding rates. So par, no cost, getting lender credit, your rate's going to go up a little bit. And of course, if you're paying discount points, you're paying for the rate to go down. So, does anybody have any questions on that one? Okay. This next one's there's a lot in it. We're just going to go over really pretty quick. It's basically the same thing. So don't all get in the weeds with the numbers and stuff like that. This probably needs to be updated. But for an example, if you're looking at this 30-year, so this is at par. So this is no cost. Okay. So you've got the interest rate here at 4%. And this is your rate. Whoops, sorry. And so, and what it does is we're comparing it to really the credit, if you will. So these are your interest rates: 4%, 4.25%, and then 3.75. So not getting into the weeds, this is where you would be no cost. Would be give you this 4% rate. You're getting a lender credit, meaning you're getting money back to help for closing. The rate would be a little bit higher. And then of course, the discount rate, which meaning you're buying the rate down a little bit, you're getting a 3.75 rate. So what that does is if we're looking basically at this one right here, the 4.25, because it's the highest rate, your closing costs right here are going to be a little bit less. Because your rate's a little bit higher, so you're getting a credit from the lender. So you're not saving really any money, but you're getting into the home because you're low on assets and needed that credit. So if you move over here to the par rate at 4%, no cost, and here your monthly savings down here in the green compared to The credit one, you're getting, it's $58.10. So, and then coming over here, because you're paying down the rate 3.75, you're having a monthly savings of 115 because you bought the rate down. So that's how that look. That's how it looked. Don't get lost in all the numbers and stuff. That probably should have all that stuff on there, but that's how that works, if you will. So again, you know, and then I put
Does that
this.
make sense, guys, how that works? I want to make sure that you guys kind of understand that because it comes up in conversation with your buyers. Especially right now when rates are high. Okay. All right, cool.
Okay. And then this is just another way of looking at it as well. This is just a visual, if you will. So the 5810, like we talked about, this is no cost. Your lender credit, you're not saving anything because actually, again, your rate's a little bit higher. And then of course, this is your discount each month because of you buy down the rate. So this is just another visual. So we can move on for this one. And this is your savings over 5 years. So I'm not going to do this one. Sorry. Okay, so most recent buyers put a lot less down than 20%. So this comes up a lot in conversation with, especially with first time home buyers, is that everybody thinks that you got to get a loan, you got to put 20% down, and that's really just not the case, especially with all the different products that we have now. It's kind of a rule of thumb, because if you put 20% down, then you don't have to pay mortgage insurance. But you know, 7% medium down payment for first time home buyers. And then 12% medium down payment for all buyers. So just be aware, and we'll get into it here shortly, but on a conventional loan, if you've got great credit, you can put down 3%. So you can put down actually less than what FHA normally requires, which is 3.5%. So the 20% rule is great if people have a lot of assets, they want to get, you know, put some equity into the home, of course, and they don't want to pay mortgage insurance. Absolutely, you know, it's a great way to go, but you don't have to put 20% down. So looking at a quick look at MI. So MI is mortgage insurance, and think of it basically as, you know, you have homeowners insurance. Think of mortgage insurance basically for the mortgage, for the lender. So if you're putting down 20% into a home, that's 20% equity that you're putting down into it. So the loan is less riskier for the lender. And so they look at it as like, okay, is this buyer going to would this buyer ever walk away from this loan, or, you know, well, from this home, if you will. So putting 20% down, the lender, you know, is like, okay, we don't need to have mortgage insurance, because, you know, this buyer's, he's got a lot of stake in it, or she's got a lot of stake in it. So the mortgage insurance goes away. Now, if you put anything less than 20% down, then mortgage insurance is required. So, and again, it's just insurance in case the loan goes into default, is really what it comes down to.
And so, John, with respect to mortgage insurance, like when I bought my West Fork house, I wanted to save my cash for the remodel. So I think I did not put 20% down, because then I figured I could refinance once I had remodeled and the value had like dramatically improved.
Yep.
Explain how like you can
Yeah.
refinance out of having to pay mortgage insurance, and if that's even a thing. I remember there was some like issue with it.
You don't have, I mean, to get out of mortgage insurance, or just to not?
Yeah, well, I was like, I don't want to pay this. It was like $35 a month or something. I was like,
Yeah,
obviously
so-
the LTV now is more than
Correct.
20%. So, you know.
Right. So I think was this slide that we had it on. Yeah. So what she was saying here, let me not get confused on this one. But so some scenarios require, like, everyone wants to put 20% down because they don't want to pay mortgage insurance. Well, mortgage insurance is based off of your credit. So if you actually have really good credit, your mortgage insurance may be pretty low. So if we have buyers that will be like, I want to do 20% down. And it's like, well, if we do 15% down, your mortgage insurance is only going to be, $75. But if you put another 5% down to get your 20%, it may cost you 50 grand. So is it worth, that to save that $75 against $50,000? Your break even could be like 27 years. So just like what Serene said, it's like, and the way these homes are appreciating right now, especially in the DFW area, it's like, putting 10 or 15% down, give it a year or two, you probably you'll build that equity up pretty quick. So a lot of people, again, think that 20% is the way to go because they're saving mortgage insurance, but the mortgage insurance may be very low compared to how much liquid they would put into the down payment. So does that make sense? So we look at that too, to make sure really if it makes, financial sense. So, so for an example on this one. So, again, don't get lost in all the numbers. Just, can y'all see my cursor or my?
Yes, we can.
Okay, cool. So, arrow, so the 30-year, 20% down. So same interest rate, all that good stuff. We're just kind of keeping everything, constant. Same amount of months, it's a 30-year. So to 20% down is going to cost you $100,000 for 20% down, right? So your loan amount is going to be $400,000. So keeping everything constant, your cash to close, let's say, is going to be $104,000, right? Well, if you put 10% down, you're going to save. It's only going to be $50,000 for your down payment. So you're going to save 50 grand, right? So your cash to close is going to be less. So this minus this is 50 grand, right? So if you put 20% down, you have no mortgage insurance. But if you put 10% down, this mortgage insurance is going to be $63. So kind of like we were saying before, if you put 10% down, you're saving 50 grand compared to putting 20% down. So the equation is here is what we would look at is that your cash to close savings with mortgage insurance is 50 grand less, right? Because you're not putting that 50 grand for down payment. And so your monthly savings, of course, for not having mortgage insurance and your monthly payment's going to be a little bit less. You're saving $302 with no mortgage insurance. So you are getting a cheaper, you're getting a lower mortgage payment each month without having that mortgage insurance because also your loan amount's 50 grand lower. But if you look at this, the break even, so you're saving $302.46 with no mortgage insurance. Now, if you come down here, it's costing you 50 grand for that though, right? So if you divide 50 grand into 302, 160, your break even is almost 14 years your break even. So you can look at that. I mean, this used to be kind of it's a break even model. But again, as Doreen was talking about, homes are appreciating incredibly around here. So
yeah, I mean, I think the point is that you guys don't need to understand like how to do this calculation. The point is to trust that the lender that you're working with is like sophisticated and savvy enough to talk to your buyer and understand what their motivation is and help them make the right choice about their loan. Like I'm normally the kind of person that would be like, I would never pay mortgage insurance. But for me at that time, when I bought West Fork and I knew I was going to use a lot of cash to improve it, it made sense for me to put less down, right? So you just have to be strategic. And that's what John and Ashton can do is, if the buyer knows, like we're probably leaving in 2 years because my wife is in her residency, it helps to have context, right?
Yes.
So
thank you.
Okay.
Yeah, absolutely. 100%. We look at of course, we know their assets too. So we don't want them buying a home and then eating ramen noodles and sitting on bean bags.
Yeah.
So we don't want to be house
My kids
broke.
would love that.
Yeah, right. It's like you want to be house broke and you're going to save, so
Yeah.
But then on the flip side too, you have people that are retired and they're on pensions and fixed income and Social Security, so they want a certain payment as well. So, but it's more what Zareen was just talking about. So absolutely, 100%. So thank you, Zareen.
No.
Okay, we're kind of wrapping up a little bit, so I hope you guys we're just going to go over the mortgage loan type of products real quick. So first, we're going to start with we have conventional Then you got your govies, your FHA, VA, USDA, jumbo, and then we're going to look at condo. And so, so conventional. So kind of what we've talked about before. You know, if you've got great credit, you know, we're probably not going to see a lot of 3% downs for, you know, with our clientele, if you will. But a lot of first-time home buyers, you can put down as little as 3%. You know, and a lot of people put down 5% as well. So a first-time home buyer is not someone that's never ever bought a home in their life. A first-time home buyer is somebody that hasn't bought a home in 3 years. So they've, you know, they bought a home a long time ago. Now they've been renting. If it's been 3 years, it's considered a first-time home buyer again. So I just want to let you know. Conventional, the minimum credit score is 620 FICO. And so, and the seller can chip in seller concessions of 3 to 9% towards closing costs. And so I have I wanted to just show you guys this real quick and bring it over. So I don't know if some of y'all have seen this. I've kind of, can y'all see that?
Yes, the mortgage minute.
But if y'all want to, yeah. So if you guys have your cameras, if you guys if you want to take a snapshot of this, I can send this out as well. But this is their max seller concessions for the different products. So for conventional loans, you know, if a buyer's putting down 10%, less than 10%, your max is 3%. And these are basis off the sales prices. And then 10 to 25% down, your max is 6%. And if a buyer actually puts down 25% or more, they can actually get 9% seller credit. If that's, you know, so FHA is 6%, USDA is 6%. And again, it says loan amount, but USDA loans are 100% financing. And then VA is 4%. So just wanted to.
So you guys don't have to remember these numbers, but it's good for you to generally know what they are, because realistically, you're going to need to know what these percentages are when you're when you're negotiating repairs and putting in like a seller closing cost credit to buyer. You just want to make sure that you don't negotiate for 13% of closing costs and the max that they can get is 9%, because then you just lost the benefit of that 4% you negotiated for. So that's why you have to just be in close contact with the lender and say, if we ask for $20,000 in closing costs, is he going to be allowed to use it all? And the lender can calculate really closely what that would be.
Thank you.
No problem.
Thank you. Okay. And again, just like we talked about before, the PMI required, you know, if it's less than 20% down. So, and all these are basically sold to Fannie or Freddie Mac. So FHA, shared by the Federal Housing Administration. And of course, this is normally a first-time home buyer product. It's because basically your credit can be 580 and above. I've seen some lenders even go lower than that to 560. The down payment amount is 3.5% is required. There's no income limit or first-time home buyer requirement. Also to the seller can chip in, like we just talked about, 6%, and max loan amounts do vary by county. I think I need to see what Dallas is, but like they're considerably lower. You can't buy there's no jumbo FHA or anything like that. So, and the ratios for these, kind of like we talked about at the very beginning, can be a lot higher. So think of it conforming the conventional loans. You can't go over 49.9. With FHA, you can go all the way up to 57. So it's a lot better for first-time home buyers. A lot of people that maybe don't have a lot of assets, they don't have the greatest credit. This is a perfect product for them. So VA loans, of course, just for active duty, reserve, National Guard members. There's no down payment. It's 100% financing, and you know, the sellers can pay up to 4%. Again, seller concessions. For VA, they have a minimum of a 580 credit score. Again, you don't have to have perfect credit. VA's got a lot of like gray area, and if you will, there's a lot of. It's a perfect product for veterans or active duty, of course. You know, especially there's a lot of active duty people that just don't, they don't have a lot of reserves. So of course they move around a lot and all that good stuff. So it's a great product. Also too, if you're a disabled vet, there's a funding fee that is required for the VA loan. It's rolled into the loan, and what it does is basically pays for all the VA loans, is what it kind of comes down to. If you have a disabled vet who's got 30% rating or more, that VA funding fee can be waived. So it's a great product. And USDA, and so we see a lot of these in the rural areas. Of course, there's no down payment. Again, it's 100% financing. You don't have to have, you have to have pretty good credit, to be honest with you. You have to have actually better credit than a conventional. So 640, because again, it's 100% financing. And so there are income limits to this. And so I have the writing down here, but it's just, you don't need to worry about that. But, and then it's for low to moderate household income. And then it's also guaranteed by the Department of Ag. And so, and we don't have too many of those.
Yeah, it doesn't happen too often.
So, but
Good to know
jumbo
about.
loans. Okay, I need to add this. So the jumbo loan. So any amount is so the new conforming loan limit is 726,200. Isn't that crazy? So that so that is nuts. So anything over 726,200 is considered a jumbo loan. And so yeah, and it made a jump from 64,700 last year. So it's pretty crazy. So you get a jumbo loan, just to kind of go over it quickly, real quick. These are non-conforming loans. So they're not like the conforming conventional loans we just talked about. So they have different risk guidelines for underwriting. Because it's a jumbo loan, they're gonna be requiring, your credit's got to be better. The ratios that we talked about at the very beginning have to be lower. And you do need more reserves, meaning more money in the bank. So normally 6 to 12 months. Again, because it's a larger loan, it's riskier for the investor. And so, yeah.
I think that's a good important point that you said, that you guys can do jumbo with only 10% down, but no MI. That's
Right.
attractive for your luxury buyers.
Yeah, we have investors that will do that. And so these jumbo loans aren't sold to Fannie and Freddie Mac, so they're not sold to the GSEs. And so it's a different type of, depending on the investor that we have. I think we've got like 9 different investors. And so they all have kind of we have a matrix of, the different guidelines, if you will. And so it just depends on the investor. And so, yeah, so we can do, it's a great
Awesome.
product. Yeah. So, and then real quick for condos, first question I would ask, because we have a lot of condos around here, is the condo warrantable? So if it's not warrantable, which we'll get to in 2 seconds, but it can run a lot of issues for your lender. Probably 95% of lenders can only do warrantable condos. So again, because this loan is going to be sold to Fannie Mae and Freddie Mac, and so they have an extensive list of guidelines, or requirements, if you will, for condos. So for example, it can't be a timeshare or operate as a condo hotel. So most condos are warrantable. So definitely around here. So again, how do you determine whether a condo is warrantable? At least 10% of the annual budget must go to reserves. At least half the units must be owner occupied. You don't want, condo hotel, basically, where everybody's everyone's doing VRBO out of the condo units. So, I mean, the best thing to do is ask the HOA in that for that condo complex. Say, hey, is it warrantable? And of course, the first time, I would make sure that you get the HOA dues for your lender, because that could superly kill a deal, especially around here at Turtle Creek. Seen some crazy $1,400, $1,500 HOA dues. It's crazy. Anyways, and so
yeah. So the other way is, I mean, if you're listing a condo, that's the first thing that you need to do, is find out whether it's warrantable or not, and who has been able to bring it to Connected and see if they can do it, and then also see who has been able to loan on it in the past successfully. So you can go and look in the MLS and see who sold there recently, and call those listing agents and say, who did the buyer end up using Because once they kind of, it just makes it easier.
Yeah, absolutely. And just ask the HOA, for the dues. I mean, I would just ask, that'd be the first thing I would ask too, right after asking warrantable. Because again, it's that PITIA, so it's like principal, interest, taxes, insurance, and HOA. So if the HOA's got, it's $800 or whatever like that, that can really mess up the ratios. So that's a very important item. So last part, what is non-warrantable? Manufactured homes, require membership, golf courses, operate as a hotel or motel, also known as a condo hotel, being part of a continuing care facility, all these different, part of a lawsuit. There's, this is kind of out of the norm, but that's what non-warrantable are. And Fannie and Freddie will not buy the loan from the lender if it's non-warrantable. So, but, and that's about it on the condos. Does anybody have any questions on the condos?
I would just, my only comment, guys, would be when you are dealing in condos, be sure you're choosing the right lender, and don't just trust someone who's like, yeah, we can do it. Like, you really need to make sure that they can do it because of the warrantability factor. And also just making sure, like we said, if someone has a budget and the HOA dues are $1,500 a month, that dramatically affects their purchasing power if they're having to also pay their mortgage and the $1,500 a month of HOA dues, like John pointed out. So just something to be mindful of, whether you're on the buy side or the list side.
I have a question.
Yeah.
John, are the condo questionnaires pretty much the same for every lender? Is it personalized to what your underwriter needs, or is it just a general questionnaire?
It's a general, it's basically a template. Yeah, it's specific to the lender, but they all ask basically the same questions. And
Okay.
yeah, and normally the cost, it'll be added to the closing costs. It's only about $300. So
Okay.
add it on
And
there.
as we get into an interesting place where the condo buildings are starting to get to, well, some of them in Uptown, for example, are starting to get to that age where things are changing a bit, like structurally, and maintenance is needing to be performed and that kind of thing. What are, and maybe there's not just a list or anything that comes to mind, but what are some of like the red flags that might get disclosed on a condo questionnaire that the underwriter would deny the loan on? Like a roofing issue, for example, or a report from the structural engineer, that kind of thing.
Right. I think it would differ per lender, but
Okay.
let me take that as a takeaway, Carrie. Actually, that's a really good question. I mean, honestly,
Okay.
yeah, because that's really good. I would think, structural integrity, of course, for basically for inspection and things of that nature. But yeah, that's a really good question. I don't know. I don't want to detour you in the wrong direction. So let me take that away, and I'll get back to you. I'll get back to everybody.
Awesome. Sounds good. Randy and I have a condo in the same building, and I just came up with this from a buyer actually who the condo questionnaire got pushed back on us. And so selfishly, I'm asking for Randy and I's future.
Yeah, no worries. It's cool. Yeah, I'll find out for you guys for sure.
Cool.
I'll find out.
Thank you.
Yeah,
Thank you.
Absolutely. 100%. Thank you for asking. I'll get there. I'll get our questionnaire too. I'll figure that out. I'll find out. He's probably a horrible neighbor. You can probably hear me.
No, I can't. We actually just found this out. So he's on like he's one of the higher floors. So I'll be taking advantage for 4th of July fireworks and whatnot. So sorry for the detour, guys.
That's great. That's great. Thank you. I think, does anybody have any questions for me? I think that's pretty much all it for the lender side. So I appreciate y'all listening to me ramble. Hope I didn't bore you.
So you want to click to what's next?
Yep.
Okay. So, and this is actually an old form. So if you stop sharing, I'm going to share.
You got it.
My bad, guys. We are sharing a PowerPoint and I did not update my portion because I'm a bad person. But let's, I will show you the new one. Well,
that,
Hold on.
Okay.
Bear with me, guys. I'm going to pull it up. I'm going to show you the differences because this form just got updated, the third-party financing addendum. And so I want to show you the change so that you guys can just be up to the minutes as of February 1st. So let's see. There we go. Okay. So you should be looking at the screen that says it's a red line. And basically what a red line is when you take an old version of a document, a new version of the document, and you like smush them over each other. So you can see the differences. And so that's what this one is. So you can see, first of all, the form that you should be using for your third-party financing should be dated 11/7/22 in the upper right-hand corner. This form is new. So if you have templates saved and things like that, make sure you go and fix your template in zip forms to have the newest version of the form. And the only change is it added an option here for other financing. And it basically is this, that covers a situation where like mom and dad are giving you a loan or you're getting a hard money loan or something like that. Because that wasn't contemplated in here before. And the 1 to 4 change now where you can't present like an offer that's getting financing as cash, because that's like misleading. So if you're, even if you're doing like a loan where there's no contingencies, like you're basically it's a cash offer, like there's no contingencies, you still have to put in there, I'm putting this much down, I'm getting this much finance, this is the total sales price. And then you would check this box and say, you know, a loan not just a loan, you would check the buyer waives all rights to terminate under the financing. And, you know, this is where you put in here, you know, you're going to put, you guys know this, the loan amount, how many years, if they're looking at 30 or 15, with the general interest rate that your lender should be able to give you, same number of loans, and then how many points. Typically, I think these days we're seeing 1 to 2 points just because of where rates are. And then, you know, if they're not sure if they're doing conventional or FHA, I would check both boxes. Just so that you don't have to like amend this later if they change courses kind of midstream. So this, like I said, this box contemplates the situation where they are getting financing like a hard money loan or for a mom and dad where there's no contingencies, and you fill in the same information and then you say they, you know, they're waiving all their rights to terminate under 2B. And then, you know, paragraph 1 shows like the types of financing they're going to pursue. Paragraph 2 shows the contingencies really. And there's, please note, time is of the essence. So there's strict adherence to deadlines, and you have 2 contingencies that are separate in this contract. 2A relates to the individual buyer qualifying, right? And if you have done your legwork up front with John and Ashton and you have your buyer conditionally pre-approved, you may be comfortable checking this box saying this contract is not subject to the buyer obtaining approval. Like the buyer's already approved, like we want to let seller rest assured that there's no contingency on the buyer themselves. Or, you know, if it's the situation where, like I said before, you want to present as cash, you would check this box and say like, there's no contingency on the buyer getting approved. If your buyer still has to go through some of the steps of approval and underwriting, you check this box and you ask your lender, how many days do we need to make sure that we are safe to move past this contingency on the buyer, right? Like ask the lender, don't just put a number in there. You need to know how long it's going to take your lender to do that. So then 2B is a totally separate contingency, and it has a different timeline. Like a lot of times, even super experienced agents get confused and think that the number that you put in here is the number of days that in which the appraisal needs to happen. And that's not the case. The timeline in this one is that if buyer's lender determined the property does not satisfy their underwriting requirements, whether it's the appraisal or the insurability or repairs, buyer no later than 3 days before closing may terminate this contract. So that's the nuance there, is that they're 2 separate timelines. There's the timeline that you write in here for the individual buyer to qualify. And then there's the timeline of not later than 3 days before closing of the property itself qualifying. Like that's when you have to have the appraisal by, that's when you have to make sure it's insurable. And in this circumstance, if the buyer terminates because they don't qualify as an individual, that they just have to give notice that they individually didn't qualify. It's like a violation of RESPA to say like why, right? In this circumstance, if the buyer terminates because the property didn't qualify, which is what you have more time for, you have to give a reason, a written statement from the lender as to why. Or like if you're terminating because of the appraisal, you have to give a copy of the appraisal. So those are two different things, and people kind of get confused about that, but that's a super important piece of this document you need to understand. And then, they modified this because, all these traditional loans, A through F, are going to require, a lien and a deed of trust recorded in the real property records. If mom and dad are giving you a loan that's not going to be recorded, that they added this language that says if required by buyer's lender, then, the note must be secured by a vendor's deed and lien, vendors and deed of trust lien. Does that make sense? Okay. And then here, you should put the purchase price here, right? In FHA, it has to appraise for the purchase price. So that's what goes in this blank. And then this last thing, they removed this language that clarifies what type of disclosures and settlement statements can be given. They just made it less confusing, I think. So that is that document. Does anyone have questions about that? No? Okay, John, what's the next document? The appraisal, this right to appraisal,
Let's see
right to
here.
terminate due to appraisal.
Section, let's see here. I'll share.
Oh, here. Well, I'm going to share the new one.
Okay.
Let's see. Where's my share screen? Sorry, I have too many windows.
Yes,
open.
you are correct, by the way. Yes.
It's the 1 to 4.
It's the, yeah.
Right to terminate due to lender's appraisal.
Yes.
Okay. All right. Well, we'll get there. So I just wanted to show you guys here. This is the additional language that's now in the 1 to 4. And again, you can see that there, you need to make sure you're using the one dated 11/7/22, because that's when these changes were approved. These are the documents that were required to be used now as of February 1st. Basically, this is the sentence that they asked, so that the term cash portion of the sales price does not include proceeds from borrowing of any kind or selling other real property except as disclosed. So, if you're presenting as cash, but you're really getting a loan, you have to disclose that now. They're trying to prevent the situation where people act like they're cash and they're not. So, and that it ties into that third-party financing addendum where you can waive, technically you can waive 2A and say the buyer's already qualified, and 2B, like all the rights to terminate. And that essentially makes it a cash offer, but you're disclosing that a loan is involved. Does that make sense? Yes. Okay, perfect.
So they can do both. In other words, yeah.
Yeah.
I mean,
you can waive it. Yes. So
great.
then one of the other pieces was here that we're just going to go through this while I have this document over, was lender required repairs. These also obviously relate to the loan. And just so you guys see what this paragraph actually says, unless otherwise agreed in writing, neither party is obligated to pay for lender required repairs, which includes treatment for wood destroying insects. If the parties do not agree, or the contract terminates, or if the cost of the repairs exceeds 5%, the buyer has the right to terminate. And I just like to point this out to you guys because it's not one that we often read, but basically, if you're doing VA or FHA, the lender may require certain repairs. It's less common in conventional loans. The seller does not have to do them. So, and then the contract would terminate, or the buyer can agree to pay to do them. If nobody agrees to do them, then the contract terminates. One thing to point out is that if there's a situation where the cost of the repairs exceeds 5% of the sales price, even if the seller is willing to do them, the buyer doesn't have to go through with it, because they may be like, this property has more problems than I thought and I don't want it. So just to make you guys aware of that. And then while I have you, this is not necessarily related to lending, but I'll just point it out, is that you guys already do this because you're really good agents, but they have now added in the contract this new blue language that says the seller is required to provide documentation showing the repairs that were done. So, you guys, it's not just saying, yeah, we did it, and then you have to come and reinspect. They have to give you a completed invoice showing the work was done. That's required in the contract now. So I think that's a really good change for you guys, because it elevates what everyone is now required to do contractually versus what you guys were just doing before as good agents. Does that make sense? Yes. Okay. I'm trying to think if there's anything else in this document, but I'll just leave it up. And I'll pull up the lender required, the addendum to terminate due to, you know, that long one. Let's see if I have this document shared somewhere. I know I do. I'm looking for it. Hold on. All right, bear with me. Does anyone have any questions about any of this?
Is it the same document as to terminate? Do you want me to-
Yeah, I can share it right here.
Okay.
Hold on one sec. I feel like we've talked about this document so many times. You guys are good sport to keep listening to me about it, but it's an important one. So we'll just talk through it one more time since that's the class we're in. Okay, so you guys are looking at my screen that says the addendum concerning there. That's a little bit bigger. Okay, so in this document, there's three. Is that big enough for you guys? There's three, you know, basically you can only use this document if you're using conventional financing. You cannot use it for FHA or VA. And so you put the property address and you can check this box, and that's a full waiver, meaning if it's $1 million contract and the property appraises for $600,000, your buyer is saying, I will bring $400,000 to closing, right? So that's where you need to be talking to your buyer's lender and making sure that if they're checking this box, that they're not writing a check that they can't cash, right? So you need to talk to your buyer's lender if you're going to use this document. The second one, it's the same thing where the buyer may say, okay, well, it's $1 million property and I want to make sure it appraises for at least 900, right? Like I'm comfortable making up the $100,000 difference, but I need it to appraise for at least 900, right? So then you put that amount in there. And again, don't put an amount in there without talking to your buyer's lender because you don't want to mess up all their ratios, right? If they have to give away extra cash, it's going to affect their loan, right, John?
Yes, ma'am. Absolutely.
Okay. And then the last one, this is the one you use in the situation where it's $1 million property and your buyer is going to, let's say it's a $2 million property and your buyer wants to stay below jumbo. So they're going to finance $700,000 and put down $1.3 million cash. Like they could pay cash, but they're like, rates are good. I might as well just take a small loan that's under jumbo for 700. Well, you know, the lender's not going to care if it only appraises for 1.5 because they're only financing $700,000, right? Or the whatever the ratio of $700,000. So the lender's not going to require that they terminate because it didn't appraise. But your buyer may say, well, if I'm putting down $1.3 million, I want it at least to appraise for 1.8 or whatever, 1.6. Does that make sense? So you use this third box in the circumstance where your buyer is putting so much down that the lender's not going to force them to terminate if it doesn't appraise, but the buyer would want to. Does that make sense? Yes. Okay. All right. I feel like I've talked about this document so much. I'm sure you guys are tired of it. John, what else do we have?
That was
We have
great. I guess section E or section 7E and 7F.
Okay, perfect. I think that's what we just talked about, but I'll
Okay.
pull it up too. The repair, section 7E. Okay. Yeah, we talked about that because that's the lender required repairs, right?
Yes.
Yes. Yeah. So we did that. Anything else?
Completion of repairs and treatments, and then
Yeah. That's it?
settlement and other expenses,
Okay, let's go look.
and then non-realty items addendum.
So there's no changes here.
Okay.
It just talks about who's paying what, right? Then the non-realty items addendum, I'm not going to really show you guys that document, and John can probably weigh in here in our last 1 minute, which is, you know, if you're keeping the fridge and the washer and dryer or whatever, the lender doesn't want to be financing on personal property, right? They're financing on the real estate asset itself. So you have to be really careful about what you put, how much money you put in that blank on the non-realty items addendum. So John, do you have a recommendation? Do you think that, I mean, they need some consideration. Would you say put $10 or are you like put 0? What do you say to put here?
I totally like,
So this is a situation where if they're going to keep fridge and washer and dryer and,
oh,
and sometimes they're saying, okay, well, I want $1,000 for if you want my fridge and washer and dryer, I want you to pay me $1,000. But I know that for lenders, that messes you guys up to see like substantive numbers in that blank. So what do you recommend?
something low.
Like $10 wouldn't bother you?
$10. Yeah, absolutely.
Okay.
Sorry.
Okay. So a lot of times then you guys will do deals where, it's like, oh, well, we want to buy the boat that's on the dock, or we want, whatever. We want to buy all the deer blinds, or I don't know, that's different because it's going to be in the farm and ranch contract. In that case, what I recommend is just, we can do a separate little deal, and Momentous can actually help you with this. Randy and I can help you put it together, where if there's a significant amount of personal property that's also going to be conveyed as part of the transaction, the lender does not want that included in the
That's
actual
what I was
sale
gonna say.
price. So we can do a separate contract and also do a bill of sale at closing. So like the deed would convey the real estate asset, and a bill of sale would convey all the personal property. So it might be $100,000 worth if you're doing the boat and the RVs and the whatevers, and we could make those kind of 2 separate deals so that the real estate loan doesn't get messed up. So that's pretty much it. Sorry, it's 10 o'clock. I don't want to keep you
That
guys.
was awesome, Zareen.
John, do you have anything else to add?
That's right. No, I don't want to go over 1 minute.
Okay, perfect.
I was kidding.
I know, that's good. Okay,
First
so
time we did this, I'm gonna look
for
too long.
CE credit, I have Larry, Vicky, John Maluso, Dottie, John Kidd, and Don Capitel. I see Michael's on here, but I didn't hear back. If Michael, if you want it, if credit, send me a message. Does anyone have questions for John? No?
It's good to see all your faces.